Okay, it's Saturday night, and we're going to do start some videos to make up for the class. You'll be missing Monday, Tuesday this week, and this is where we last left off with this slide from Chapter 5, what is included in income, and the important point here is I just want to drill it home that when I see you this coming week on Wednesday and Thursday, when I see the different sections those days, I'm going to start off class and say, all right, what income is taxable? And I want everyone to sort of shout out at the same time this phrase from whatever, well, you can include the word income from whatever source derived. That's a key to the practice of taxation, that whatever source the income comes from, it's taxable. And then, of course, we did learn as well, and we're going to continue this throughout the course, that unless there's a specific statute of exception, everything is taxable. So if you don't see an exception, it's taxable. That reminds me, I want to send out those checklists with CCH or other tax services if I can, just so you can get a notification of it. It may be included in the textbook. You can check. All right, let's move along. We also got involved in this slightly, that income is to be recognized when you've received an economic benefit and when you realize the income. So it's sort of two tests. One is that there is an economic benefit, and that economic benefit generally means that you are, and this is my interpretation of it, which I think works pretty well, and that means you're wealthier. You become richer, if you want to use that word. So if you want to know, did you receive a benefit? Are you wealthier because of the income received? And so that's two tests, including the realization. That's why loans, we learned that if you borrow money, a loan is not income when you receive the money. But we did also learn that should the loan be forgiven, if it goes away because the person who lent it to you says, just don't pay me back, if you cannot make the argument that it's a gift from the person who's forgiven the loan, then then it becomes income. So general rule, if there's a forgiveness of debt, if debt is, quote, wiped out by forgiveness, then you've got to check to see whether or not you've got income from that. Okay. This is sort of saying a little bit more detail what this last slide was, adding to what I just said. Economic benefit, borrowed funds, not income. But if you are wealthier, you do have income realization. Here's a little more detail. It's your money. It becomes your money. When whatever you receive, whatever dollars you get, it's yours, and that's called the realization. And realized income is also considered recognized, so the two go hand in hand. It's basically what it's saying here is that if you've realized income, you have to recognize it as income. Now, there are certain provisions in the code where you don't have to recognize it as income when it comes in. That would be under certain deferral or exclusion provisions, but they're going to have to be by statute. There'll have to be a code section addressing the issue, and of course we'll learn some of those as we go along. Okay, here we go. The form of receipt question, does it matter? I think the answer here is not actually. Let's talk about this for a minute. If the income you receive is typically going to be in U.S. dollars, well, that we understand. We understand that to be taxable. Suppose you receive inventory or goods. Let's call it goods. You receive property. Somebody says, oh, I see you did my tax return. So I'll tell you what, let me bring over dinner for you. I'm a chef at a restaurant. Let me bring over dinner for you. You told me that the tax return cost me $150. That's how much you billed me. I'll bring you a meal worth $150, and we'll call it even. I won't owe you any more money. Well, you can say, fine, do that, bring it over to me, and you can enjoy the meal, hopefully. But that doesn't mean that the value of the meal is not taxable. It certainly is taxable. So how it's paid, how you become wealthier, how you get your economic benefit is not important. And that leads us to one more conclusion, which is to say that bartering does not avoid taxes. Barter does not avoid taxes. Still taxable. And that barter arrangement could be the same example we gave here. The person who owed you money gave you property. All right, return of capital. This is another real important principle. The cost of an asset is called its tax basis. We're going to get used to that phrase. And return of capital means the tax basis is excluded when determining the income. And this bullet here takes the thrust of what I would have yelled and screamed on this point right away from me, because this is exactly what I would have said, is that there's no economic benefit from it. Let's take an example. There is a slide that's going to do this again. Let's just see if it's not the next slide. No, it's not. So let's do it here, but we'll see it when we get it again, and we'll breeze through it when that happens. But here's the idea. You go out and you pay for a car. Let's say you buy a used car for $1,000. So that becomes what we call the technical language we use is adjusted tax basis. We put the word adjusted in there because it could be that it'll be depreciated or amortized. So we'll usually use the term adjusted tax basis. Technically, you could say this is just the tax basis and leave it at that, but to get you used to the actual terminology that we'll use most of the time, us tax practitioners. In practice, the adjusted tax basis. Now, if this is a personal car, there will be no depreciation. Only in a business setting is there depreciation. So the adjusted tax basis will always remain $1,000. It'll never go below what you paid for it. But what happens is, in this example, let's take the example a little further. You sell the car for, let's say, $1,500. Why? Oh, I don't know. You're a good salesperson. Okay. Your adjusted tax basis, ATB, let's call it, your adjusted tax basis is $1,000. So on the cash you receive, the $1,500, only the net $500 is taxable. Because of the $1,500, the first $1,000 is just a return of your capital, return of your basis. And the bullet point is how much wealthier are you through this transaction? And the argument is, well, the cost of the car is $1,000. You got back $1,000 plus $500. The only addition to wealth that you have is this $500. That's your gain. We can call it gain, or we can call it increase in wealth. Hopefully you're seeing that and catching that. All right, and so this last bullet drives the last point home that I just made, gain from the sale. What did you gain? And there's a certain economic element into this. What is your gain? It's not pure economics, but there's an economic element. Are you wealthier? And how much wealthier are you? And that's always a key to the recognition of how much income you have to include in taxes, how much wealthier are you from the transaction. Okay, a couple other concepts here. Let's tell you what we'll do. This is a big concept, the tax benefit rule. So we're going to stop here, and we'll come back and pick up on this big doctrine, which is now a tax code section. And if you're interested, you might want to read ahead in what we call section 111. That's the tax benefit rule. This sign here, which I didn't make perfectly well, let me show you, is the tax practitioners or legal people sign for section. I'm not sure how it came about, but you can figure, lawyers figured it out, so we wouldn't know what the heck they're talking about. It simply means Section 111. See you on the next go-around.